cut to interest rates. That's what we heard from the Bank of Canada today. So what's next for the loonie and the Canadian economy? David Tulk, Chief Canada Macro Strategist, is here with me from TD Securities. David, were you surprised with this announcement?
Yeah, I think we were a little bit surprised with what happened. We were thinking that the bank would be more concerned with the decline in the price of oil and the fact that they hadn't really seen very many of the other positive offsets emerge from the currency weakness. So we felt as if you're going to operate monetary policy as an exercise in risk management, you want to get out a little bit ahead of some of these factors.
So what's next for the loonie?
I think it'll be very closely tied to how the price of oil unfolds. So as we've seen continued weakness here, which is something interesting to look at how the currency is traded in response to the bank. So it initially strengthened given the fact that the bank didn't cut as some had expected, but then it quickly weakened again on the recognition that oil prices continue to push lower and that risk sentiment continues to deteriorate globally.
And do you think this will actually hurt oil now?
In terms of what the Bank of Canada will do, it probably doesn't really go in that direction in terms of the causality. I think the fundamentals that are working through the oil market, where you still see a fair amount of supply and weakness in demand, suggest that we're probably still looking at weakness at least over the next 4 or 5 months. I think over a longer horizon, you'll have to gauge how the supply response evolves. And at these price levels, a lot of projects are uneconomic. So if that supply is curtailed, then you could see a little bit more of a bounce in the price of oil. But that feels like it's more of a half of 2016 story.
So are we on hold now with interest rates for the next couple of years?
I think we'll wait to see how that unfolds. There's still a lot of downside risk that exists in the global backdrop. So if we're particularly concerned about conditions in the United States, and a lot of the bank's optimism, I guess, is premised on the United States doing fairly well. So if those things will unfold in a way that disappoints the bank, they could certainly follow through with an additional cut. But if you take their tone as given today, it seems like they are comfortable being on hold for the foreseeable future.
So overall then for the Canadian economy, more of the same?
Yeah, I think it'll probably end up looking a little bit like a muddle-through type of scenario. Certainly the positive offsets that we had hoped to see coming through the weaker currency have yet to be fully realized. So instead we're left to still focus on some of the downside risks, but that in its own right could still turn around in time. So we'll have to see the most recent depreciation in the currency, what that does to maybe help the export sector. And we're also waiting for some of the fiscal stimulus to come out of the Liberal Party, which could also provide a little bit of a fill-up for growth as we get in towards the end of this year and into 2017.
All right, so no cut today, but we could see one. Thank you very much, David. I've been joined by David Tulk, Chief Canada Macro Strategist at TD Securities. I'm Marianne Devaney. Thanks for watching.